Well, good morning, good afternoon, or good evening, whatever time it is, wherever you are tuning in. I'm sitting here in Omaha, Nebraska, just like I have for most of my life. The, People often ask me, Warren, what's the biggest lesson you've learned in all these decades of investing? And I always tell them the most powerful lessons are usually learned the hard way through mistakes. I've made a few doozies, let me tell you, enough to fill a good-sized book of dumb decisions. One that still sticks in my craw like a stubborn little piece of peanut brittle caught between your teeth was back in 1993. It was a business called Dexter Shoe Company. We bought it for about $33 million, paying with Berkshire Hathaway stock at the time. What a bonehead move that was. I was so enamored with the idea of a simple, straightforward American business churning out shoes. They had a great history, a solid reputation, a loyal customer base, and a management team I admired. I thought, this is a sure thing, a wonderful business at a fair price. Boy, was I wrong, dead wrong. I remember Charlie Munger, my partner for over 60 years, he just looked at me with that knowing look, a slight shake of his head, maybe a little sigh that only Charlie can produce. He didn't say, I told you so then, not directly, but I knew he was thinking it loud and clear. I was convinced it was a wonderful company at a fair price, maybe even a wonderful price. But I didn't see what was coming, the tidal wave of foreign competition that would completely swamp the American shoe manufacturing industry. It wasn't the management's fault. They were good people, dedicated to their craft. It was a structural problem, a complete erosion of their competitive advantage, their moat. We basically swapped good Berkshire stock shares that would have compounded into billions over the following decades for a business that quickly became worthless. I wrote in a shareholder letter years later that if I had been a painter, I would have used Dexter as a model for dumb. It was a mistake of omission, a mistake of commission, a mistake of valuation, and a profound mistake of understanding the competitive landscape. That $433 million to Stater cost us far, far more in opportunity cost over the decades, probably upwards of $3.5 billion or more when you factor in the compounding of those Berkshire shares we gave up. It still makes me wince just thinking about it, even all these years later, sitting here at my desk in Omaha. It's an expensive lesson, but a powerful one, and it taught me, or rather, it reinforced one of Ben Graham's core teachings in a brutal way: focus on your circle of competence and understand the business. Here's what I learned from that mistake, or rather what was hammered into my thick skull once again: the importance of a sustainable competitive advantage, what we like to call a moat. When I looked at Dexter, I saw a good, honest business, but I failed to truly understand that its moat, its protection against competition, was rapidly evaporating. It was a castle without a wall, just waiting for the barbarians at the gate. Ben Graham, my professor at Columbia Business School, he drilled into us the concept of margin of safety, buying a dollar for 50 cents. But Phil Fisher, another great investor, really opened my eyes to the qualitative aspects to looking for companies with durable competitive advantages, not just statistically cheap ones. You see, investing is really quite simple. It's not complicated math or fancy algorithms. It's about finding wonderful businesses at fair prices and holding them for a long, long time. But how do you identify a wonderful business? It's one that has a durable moat, something that protects it from competitors. Think about See's Candies, a business Charlie and I bought for $25 million back in 90. It wasn't a huge business, maybe 30 millions in sales, but it had an incredible brand. People in California, especially during holidays, they just had to have See's. They'd pay a little more for it. That's a moat. That brand power allows you to raise prices a bit each year without losing customers. It's like having a toll bridge that everyone has to cross. Dexter Shoe, unfortunately, had no such moat. Its product was a commodity, easily replicated and outcompeted on price by manufacturers from lower cost regions. The minute the competition became fierce, their profits vanished. It's a stark contrast to a business like Coca-Cola, which we invested heavily in starting in 1988. Now there's a moat, that taste, that brand, that distribution system across the entire globe. Nobody could replicate that for $100 billion. people will pay a few cents extra for that red can, not because of the sugar water inside, but because of what the brand means to them. That brand loyalty is an emotional moat, and it's incredibly powerful. So the lesson from Dexter, the very expensive lesson was to stick to what I understand and to only invest in businesses with wide, deep, and durable moats. If I don't understand how a business protects itself from its competitors, I just don't invest. Doesn't matter how cheap the stock looks, price is what you pay, value is what you get. But if the value is eroding because the moat is gone, you're not getting anything. It's better to be roughly right about a great business than precisely wrong about a mediocre one. That's a Charlie Munger special, that thought, and he's always reminding me of it, which is why he's such a valuable partner. He stretches my thinking, helps me avoid some of my dumber impulses, though clearly not all of them. Let's look at a supporting example, a positive one this time, to illustrate the power of moats. Take American Express. Back in 1964, the company faced a huge crisis with the salad oil scandal. A guy named Tino DeAngelis defaulted on massive loans, leaving American Express holding the bag for hundreds of millions of dollars of worthless collateral, salad oil that turned out to be mostly water. The stock plummeted. Everyone thought American Express was going under. Banks were refusing their travelers' checks. I flew to New York, walked into dozens of restaurants, and ordered food, only to pay with an American Express card, watching to see if they'd take it. I saw people still using their travelers' checks. The brand, the trust people had in American Express was still there despite the headlines. It was an emotional connection, a habit, a convenience. I understood the business. I knew it had a mode of trust and brand recognition. So while everyone else was running for the hills, I put 40% of my partnership's capital, about $13 million, into American Express stock. At the time, that was a huge bet for my little partnership. I was running in the 1960s. That investment paid off many times over because the underlying business, its relationship with its customers, was sound. The moat, or consider Geico, the insurance company. My dad, who ran a stock brokerage during the Depression, knew about Geico. And I first learned about it when I was 20, visiting my old professor, Ben Graham, at his home. He asked me what I knew about Geico, and I knew nothing. He told me to go learn about it. So I took a train to Washington, D.C., knocked on their door, and met Lorimer Davidson, the financial vice president. He spent 4 hours explaining the business model to me. Geico sold insurance directly to government employees, bypassing agents, which gave them a huge cost advantage. They had a lasting competitive advantage, a structural cost moat. I invested 75% of my meager savings, $10,000 to $282 into Geico stock at the time. I quickly sold it for a small profit, which was another mistake in hindsight, but the lesson stuck. Find companies with clear, sustainable advantages. Years later, Berkshire bought Geico outright for its incredible business model and powerful brand, and it has been a phenomenal performer for us. If you're a young investor today sitting there thinking about how to navigate these choppy waters, what I'd tell my younger self and what I'd tell any new investor is this: you don't need to do extraordinary things to get extraordinary results. What you need is patience, discipline, and a focus on understanding businesses. Forget trying to predict the market. Forget listening to pundits on television who are paid to talk. Focus on owning pieces of great business. Look, the truth is, the market is there to serve you, not to instruct you. Imagine Mr. Market, the manic depressive fellow, shows up at your door every day offering to buy or sell you your share of a business. Some days he's euphoric, offering you a crazy high price. Other days he's depressed, desperate to sell you his shares for a pittance. Your job isn't to take his emotional temperature, it's to take advantage of his folly. When he's depressed, you buy. When he's euphoric, you hold, or maybe even sell a bit. But mostly you just ignore him and focus on the underlying business. People think you need fancy math, complex computer models, or insider information to succeed in investing. That's hogwash. What you need is a clear head, a stable temperament, and a willingness to do the homework. I spend 80% of my day reading annual reports, 10Ks, industry magazines, newspapers. I'm just looking for facts that help me understand businesses better. You don't need a high IQ. I've seen plenty of people with 160 IQs fail spectacularly because they lack temperament or common sense. Common sense and patience will beat raw intellect most days of the week when it comes to investing. This applies to any business, not just investing in stocks. What really matters in business is finding an enduring advantage. If you're starting a business, think about what makes you different, what makes you better, what builds that moat around your castle. It could be a strong brand, a cost advantage, a unique product, a patent, or even just incredible customer service. Without it, you're constantly fighting a battle on price, and that's a losing game over the long haul. We learned this early on at Berkshire Hathaway itself. When I took over, it was a textile mill, a dying industry. I kept putting money into it, trying to modernize, but it was like pouring money into a bottomless pit. There was no moat left. So we started using the cash flow from the textile operations, meager as it was, to buy other businesses, those with moats. That's how we eventually transformed Berkshire into what it is today, a collection of wonderful businesses with durable competitive advantages. Buying Berkshire was a $200 billion mistake in terms of opportunity cost. I should have just bought the insurance business from scratch instead of using the textile mill as a vehicle. But it taught me a valuable lesson about allocating capital from a dying business to thriving ones. But that's not the only lesson I learned the hard way. This reminds me of another time when I let emotion get the better of me, where I acted on impulse rather than logic. It's a classic mistake, one that many investors fall victim to, and it concerns the very nature of human behavior when money is on the line. The next mistake cost me even more than Dexter Shoe in pure aggravation, though perhaps not in direct dollar loss of capital. It was a mistake of patience, or rather, a distinct lack of it. Back in the early 1960s, a fellow named Seabury Stanton, who ran the New Bedford textile mill where Berkshire Hathaway was located, started buying back shares of Berkshire below what I thought was their intrinsic value. He was taking advantage of shareholders. My partnership owned a substantial chunk, and I was trying to buy more to get control. One day, he made a firm offer to buy our shares at $11.50 apiece. I verbally agreed to sell them. Later, he sent a written offer, but for 11. He lowballed me by an eighth of a dollar. Now, that might not sound like much, a mere 12.5 cents per share, but it infuriated me. It was the principle of the thing. What a fool I was. I got so mad that I decided right then and there that I wasn't going to sell. Instead, I started buying up more shares of Berkshire Hathaway, eventually gaining control. My intention was to fire Stanton and run the textile business better to prove a point. And I did fire him, but the textile business itself was a dog. It was an industry in secular decline, a real value trap. My anger over a tiny difference in price led me to invest millions more into a fundamentally flawed business just to spite someone. That was a textbook example of letting emotion, specifically stubbornness and ego, dictate an investment decision. Rule number one is never lose money. Rule number two is never forget rule number one. And I broke both by letting emotion control my capital allocation. The real value of Berkshire Hathaway eventually came from redirecting the capital from that dying textile operation into other businesses that had moats like insurance. If I had just taken the £11.50, I would have put that money into something much more productive right away. That initial act of petty spite ended up costing us decades of effort and capital in a difficult business. It eventually worked out wonderfully because we changed course, but it was a long, hard lesson about the dangers of emotional. Be fearful when others are greedy, and greedy when others are fearful, but never ever let anger or ego drive your decisions. The market doesn't care about your feelings, only your money. Another huge lesson that ties into all of this, one that Ben Graham absolutely pounded into my head, is the concept of a margin of safety. It means buying something for significantly less than you calculate its intrinsic value to be. It's like building a bridge that can hold 30,000 pounds, but only ever driving 10,000-pound trucks over it. You want that extra cushion because things rarely go exactly according to plan. The future is uncertain, and you need protection against unexpected events, against your own miscalculations, and against the general messiness of the world. When we bought See's Candies, we bought a wonderful business, but we also bought it at a fair price, a price that gave us a margin of safety. We paid $25 million for a business that was earning about $4 million pre-tax at the time. That was a high multiple for the time, but the brand was so strong and the capital required to grow it was so low that we knew it would generate tremendous cash over time. And it has. Sears has generated over $2 billion in pre-tax earnings for Berkshire since we bought it, all on that initial $25 million investment. That's the power of finding a wonderful business at a fair price with a margin of safety. I've been doing this for over 70 years now, starting with my first stock, City Service Preferred, at age 11. I paid $38 a share, watched it drop to $27, then rebound to $40, at which point I sold for a tiny profit. Of course, it then zoomed up to $200, teaching me about the foolishness of trying to time the market and the power of patience. That early mistake stuck with me. Compounding is the eighth wonder of the world, as Albert Einstein supposedly said. And it's true. Time is your friend when you own wonderful businesses. Our favorite holding period is forever. Think about Coca-Cola again. We started buying in 1988, eventually investing about $1.3 billion. Today, that investment is worth well over $20 billion, and it pays us hundreds of millions in dividends every year. We didn't do anything special, didn't use fancy algorithms, didn't try to predict quarterly earnings. We just understood the business, believed in its enduring global appeal, and held on. We still hold on. It's really quite simple. Find a business you understand, one with a durable competitive advantage, run by honest and capable managers, and buy it at a sensible price. Then do nothing. That last part, do nothing, is often the hardest for people. The human brain is wired for action, for constant stimulation. We see charts, we hear news, and we feel compelled to react. But often, the best thing to do is absolutely nothing. Just sit there in Omaha, read your newspapers, play some bridge with Charlie or Bill Gates, and let compounding do its magic. Most people fail not because they're stupid, but because they can't sit still. My dad taught me a lot about integrity and financial prudence. He was a conservative man, and he taught me to value a dollar, to live within my means, and to avoid debt. I've never borrowed significant money to invest. People get into trouble when they use leverage on stocks. It magnifies gains when things go well, but it can wipe you out when things go bad. Even if you're sure you're right, even if you know a business is undervalued, if you're using borrowed money, a sudden downturn, a crisis, can force you to sell at the worst possible time. It's simply not worth the risk. Sleep well at night. Don't gamble with borrowed money. At Berkshire, we've always prioritized financial strength. We want to be absolutely unshakable no matter what economic hurricane might come our way. That means having plenty of cash, not taking on excessive debt, and understanding the risks we're taking. That's why Ajit Jain, who runs our insurance operations, is so critical. He understands risk better than anyone I know. We build our fortress to withstand anything, so we can be greedy when others are fearful and have the capital to act decisively when opportunities arise, just like we did with American Express, or more recently with Bank of America after the financial crisis. A shareholder once asked me at our annual meeting, surrounded by 40,000 folks in the CHI Health Center in Omaha, Mr. Buffett, how do you find such great ideas? And I told them, I just keep turning pages. I spend 5 to 6 hours a day reading annual reports, industry journals, business biographies. I'm just looking for good ideas for businesses I can understand, for managers I can trust. It's like prospecting for gold. You have to sift through a lot of dirt to find a nugget. But the more dirt you sift, the higher your chances. You don't need 100 nuggets. A few good ones can make you rich. Think about Apple. For years, I avoided tech companies largely because I felt they were outside my circle of competence. I didn't understand the rapid technological change, the constant obsolescence. Charlie always jokes that I prefer businesses that operate like a medieval duchy rather than the Wild West of Silicon Valley. But with Apple, things changed. I started to see it not just as a tech company, but as a consumer products company with an incredibly powerful brand, a product ecosystem, and immense customer loyalty. People absolutely love their iPhones. That's a moat. It's like Coca-Cola in a different form. We now have a significant stake, and it's been a fantastic investment for Berkshire. It shows that your circle of competence can expand, but only slowly, and only when you truly understand the underlying business model. So after 80 plus years of doing this, here's what I know for certain. Lessons hard-earned and often paid for dearly. Investing success doesn't require a stratospheric IQ, nor does it demand inside information or extraordinary luck. It requires a sound intellectual framework, the ability to control your emotions, and a long-term perspective. It means focusing on businesses, not stocks, as mere pieces of paper that jump up and down on a screen. I'm 93 now, and if I could tell young investors one thing, it would be to start early, save diligently, and invest consistently in broad-based, low-cost index funds if you don't have the time or inclination to learn about individual businesses. For those who do want to pick stocks, spend your time understanding how businesses work, identifying those with durable competitive advantages, and buying them at sensible prices from a Mr. Market who's having a bad day. And simply hold on. Our economic system, America, is a magnificent engine for wealth creation, and I'd never bet against it. You don't need to be brilliant. You don't need inside information, and you don't need to do extraordinary things to get extraordinary results. What you need is patience, discipline, and a focus on understanding business fundamentals. Remember Ben Graham's core principles: buy with a margin of safety, and view stocks as ownership stakes in businesses. Let the miracle of compound interest work for you over decades. It's not a sprint. Just keep reading, keep learning, and keep your head screwed on straight. Thanks for listening.